I just did something that every finance creator tells you not to do. I sold the S&P 500. And before you come for me in the comments, let me explain. If you follow me on TikTok or Instagram, you know I preach about ETFs as if they're the gospel. And to be honest, I still wholeheartedly believe that it's the best thing a beginner investor can put their money into. You get instant diversification, exposure to hundreds or thousands of companies in one go, and you don't need to know a single thing about researching individual stocks to get into them. So I'm still bullish on them. That hasn't changed. But, and this is a big but, I did not sell all my ETFs. I only sold the S&P 500. And today I'm going to walk you through exactly why I did that, every single stock that I've bought, the companies and what they do and why I'm bullish on them. And if you want to support someone that doesn't gatekeep anything to do with personal finance, make sure you like, comment, and subscribe. Right, so let me set the scene. I'm in my 20s and I've been investing in the stock market for just under 4 years now. I'll put my first investment somewhere on the screen, but it was in September 2022 and it was £2,000 into the S&P 500. Literally since then until the start of this year, all I invested in was the S&P 500 every single month. And then at the start of this year, I moved my stocks and shares ISA from Vanguard to Trading 212 because there is way more ETFs and stocks that you can invest into. And once the portfolio transfer was done, I created my own pie, which was 70% the Invesco FTSE All-World and 30% S&P 500. This was just to give me more exposure to different countries, since the S&P 500 is completely America. To be fair, both of the ETFs have done pretty well this year, but I was recently thinking to myself, I'm too young to be playing it this safe. And one of the best things about being young and investing is that you literally have time on your side. Time to ride out market dips, time to recover from mistakes, but also time means that I can afford to take risks. More risk than, say, someone that's in their 50s, for example, and needs the money soon. So I've been thinking about increasing the risk profile of my portfolio while I'm still young. And I also believe that we are in a bull market that has serious legs. I still think we've got a couple more years to go. In my opinion, and this is solely just my opinion, but I believe that as long as Trump is in charge of the US, there's going to be serious money flowing into the stock market. Say what you want about him politically, but before anything else, the man is a businessman, and businessmen want the economy to look good. So personally, I think the environment we're in right now is one where taking a bit more risk is a calculated move and not a reckless one. Now, before we get into my portfolio, I just want to make this clear that I am not a financial advisor. I'm not a stock market guru. I'm just someone that's done a little bit of research and I'm sharing what I am doing with my own money. That's it. So please do your own research before making any decisions because this is by no means financial advice. I'm not telling you what to do with your own money. Let's get into my portfolio. Got my laptop here just to make sure that everything I say is accurate. So right now I am still 80% in ETFs. So when I say I sold my ETFs, I didn't just abandon my strategy. I mean that I've just taken a slice of that allocation and moved it into individual stocks. My ETFs are now split 65%, 35%. 65% in the Invesco FTSE All-World, which gives me exposure to thousands of companies globally, both in developed and emerging markets. A lot of people ask me why I invest in the Invesco one and not the Vanguard one, and it's pretty much just because of the fees. This one is a little bit cheaper. But now the other 35% is in the VanEck Semiconductor ETF. And I'll explain why I made the swap in a minute, because I actually sold my entire S&P 500 for it. And like I mentioned before, I took 20% out of my portfolio, which was roughly £14,500, and invested it into 6 individual stocks. So I'm going to walk you through all the changes, but let me start with the semiconductor ETF because this is probably the most important one that I made. So I completely sold the S&P 500 and moved into the VanEck Semiconductor ETF, ticker SMGB. Now, I don't think the S&P 500 is bad. I still think it's a good investment. But the only thing about it is that you're holding a lot of dead weight alongside the winners, which I'm already doing in my global ETF, the Invesco FTSE All-World. The VanEck Semiconductor ETF is the complete opposite. It's concentrated to 25 companies and they're all involved in designing, manufacturing, and supplying semiconductors. We're talking Nvidia, Broadcom, ASML, AMD, Intel, Micron, literally all the big names in the chip world. And the reason I think this is the ETF of our era is simple. Everything runs on semiconductors right now. Just think about it. Your phone, semiconductors. Your laptop, semiconductors. The car you drive, especially if it's an electric vehicle, semiconductors. Every AI model being trained right now, semiconductors. Data centers, semiconductors. Medical equipment, satellites, even your washing machine and your fridge, if it's smart, semiconductors. The entire AI ecosystem that we're living through right now literally runs on the chips that are being made by the companies in this ETF. And I just don't see us going backwards from here. Every industry is becoming more digital, more automated, and more AI integrated, which means the demand for semiconductors is just going to keep increasing. Yes, it is going to be more concentrated and more volatile than the S&P 500, but that's a risk that I'm willing to take in my 20s. And I think this is a smarter way to get growth exposure rather than a broad index that gets carried down by slow moving companies. So that is my ETF collection. It makes up 80% of my portfolio and 65% is in the Invesco FTSE All-World, with the other 35% sitting in the semiconductors ETF. Now let's get on to my 6 individual stocks. First up, and this is my biggest individual stock position, is Celestica, ticker CLS. Now Celestica is not a sexy name. Actually, it kind of is. I wouldn't mind my girl being called Celestica. But what I mean is that it's probably not one that you've heard of, but what they do in this day and age is incredibly relevant. Celestica is a contract electronics manufacturer. Essentially, they build the hardware that powers AI infrastructure. We're talking data center components, servers, networking equipment, essentially just the physical backbone that AI runs on. Think of them as one of the companies behind the scenes making the picks and shovels for this current AI gold rush. And their financials are very hard to argue with. Now, as somebody that works in finance, I will never invest in a company if their finances aren't together, but Celestica's luckily are. In Q1 this year, their revenue came up to $4.05 billion, up 53% compared to this time last year. Their AI and data center segment grew 76% year on year, and now it makes up for 80% of their revenue. And they've raised their full-year guidance multiple times. They're now guiding for $19 billion in revenue. But the main reason that I'm bullish is that AI infrastructure spending is not slowing down. Amazon, Google, Meta, they're all spending billions on data centers. And Celestica is one of the companies that's actually physically building it. So long as that trend continues, Celestica is a direct beneficiary. Next in my portfolio is Vertiv, ticker VRT. If Celestica builds the hardware that goes inside the data centers, Vertiv is the one keeping those data centers alive. They make the power systems and cooling infrastructure that stops AI servers from literally overheating and shutting down. As AI models become more powerful, they require more energy and generate more heat, which means the demand for what Vertiv creates is only going to go up. Financially, they are flying as well. Their revenue is up 30% year on year. Operating margins expanded by 4.3 percentage points in a single quarter. And this is the one that really got me. Their order backlog is over $15 billion. That is contracted, committed revenue sitting in the pipeline. You do not get $15 billion of backlog unless your customers are extremely serious about what they're ordering. And then there is the NVIDIA partnership. So Vertiv are co-developing next generation power architecture directly with NVIDIA for their most powerful AI chip platforms. If that doesn't scream cash money, I don't know what will. Power and cooling for AI is a non-negotiable bottleneck. You cannot run AI without solving the energy problem, and Vertiv is one of the companies that are positioned to solve it at scale. Third on the list, and one of my favorite apps, is Reddit, ticker RDDT. Now, Reddit is actually the social media app that I spend the most time on outside of YouTube and TikTok. So this one is a bit more of a personal choice for me. However, if I'm on it for hours, it means that other people are on it for hours, and advertisers follow eyeballs. But beyond the love story between me and Reddit, their financials are genuinely acceptable, even compared to some of the other stocks on this list. Their revenue is up 69% year on year. They've got a net profit margin of 31%, and their free cash flow margin is 47%, with capex spending of just $1 million in the previous quarter. $1 million of capital expenditure on $663 million of revenue is an almost absurdly capital light business. Also, their earnings per share more than doubled year on year, and they have $2.77 billion in cash with virtually no debt. With strong growth, profitability, and a valuation that is still lower than their peers like Meta, there is still a lot of space for this stock to run. On to fourth on my list, we have Astra Labs, ticker ALAB. This one is the most technical, so bear with. They make connectivity chips, specifically semiconductors that allow different components inside AI data centers to talk to each other at extremely high speeds. It's basically like the nervous system connecting all the AI hardware together. As AI models get bigger and more complex, their components need quicker transfer speeds, and this is exactly what Astra solves. And the finances here might be the strongest of any company that I've looked at during this research process. Their revenue is up 93% year on year, and they have gross margins of 76.4%, which is exceptional for a chip company. Astra is pretty much embedded in the infrastructure that every major AI model depends on. Fifth on my list is SoFi, and the ticker is SoFi as well. The easiest way that I can describe SoFi is, imagine if Starling Bank and Revolut had a baby, but it was American and publicly listed. It's a financial services company that pretty much offers everything: home loans, student loan financing, personal loans, investing, all in the same app. Very much the kind of fintech that appeals to the demographic that I talk to on this channel. The interesting thing about this one is that their fundamentals are excellent, but the stock is near its 52-week lows at the time of recording this. The stock was down because there was a report made about them that raised questions about their financial reporting, which spooked investors. But the underlying numbers keep coming in strong, management keep beating expectations, and at current prices, there's a case to be made that the market has overreacted. Digital banking is still in its early stages in the US, and SoFi is one of the few fintech companies that actually has a banking license. If they can keep the momentum up and they keep executing, then the current price could look like a real bargain in a couple years. And last on my list, the smallest position in my portfolio is EverQuote, ticker EVER. Ever. I'll be real with you, this is my highest risk play, which is exactly why I've allocated the least to it. EverQuote is kind of like the US Go Compare. It's an online insurance marketplace that connects people looking for home insurance, car insurance, and renters insurance with the insurance companies themselves, and then the insurers pay EverQuote for those leads. It's a simple business model, but it's highly dependent on insurance carriers being willing to spend on customer acquisition. They're also buying back their own shares, which is a sign of management confidence. It's not the flashiest on this list, but it's profitable, debt-free, and cheap relative to its earnings. So that is the full breakdown. 80% in ETFs and 20% in 6 stocks, each one chosen after going through the financials properly, showing revenue growth, profit margins, balance sheet strengthening, and competitive positioning. I don't plan on rejigging my portfolio again anytime soon. This one feels like a setup that I'm genuinely happy to let play out, but I might pick up more individual stocks in the future, who knows. But if I do change anything around, I'll be sure to update you lot. I'll make a video on it. That's what this channel is for. I'm going to be making a lot more content on investing and also personal finance, but I'll be doing portfolio updates so you lot can see how this is progressing too. Anyways, that was our portfolio. If you've got any questions about the ETFs or stocks, drop them in the comments. And if you're not already following me on Instagram, TikTok, even Facebook, @LoopsLively, come find me there for the short form content. Stay lively.